Something critical is unfolding in the gold market right now, and most people are completely missing what the charts are actually telling them. What you're about to hear isn't speculation, it's not noise, it's a convergence of signals technical, fundamental, institutional, and geopolitical that only comes together once every several years. And if you're sitting on retirement savings, watching your dollar denominated account slowly erode, you need to understand what this moment actually means. Let me paint you a picture. Gold recently did something extraordinary. It climbed to all time highs, levels that not a single mainstream financial analyst seriously projected just a few years ago. The world watched in a mix of disbelief and quiet confirmation as gold broke through one ceiling after another: $3,000, $4,000, $5,000, all in the space of roughly a year and a half. And then something happened that felt, to the untrained eye, like the run was over. Gold pulled back, hard. It corrected from those dizzying peaks, and all the naysayers came rushing back. See? Told you it was a bubble. The gold rally is done. Time to rotate back into tech stocks. You heard the same chorus you always hear at every major correction in a bull market. But here's what those people are missing, and here's what I want to spend the next several minutes showing you. That pullback wasn't the end of anything. It was the setup, the coiling, the compressed spring before the next launch. And right now, gold is sitting at a critical technical juncture that, in the history of this metal, has almost always resolved in one direction: higher. Think about what a real breakout looks like before it happens. It doesn't announce itself. It doesn't come with a press release. What it looks like, almost every single time, is a period of tight consolidation, decreasing volatility, shrinking price ranges, and a slow, almost boring buildup of tension. The chart forms what technicians call a compression pattern, price wedging tighter and tighter against a declining resistance line. And that's exactly what you're looking at in gold right now. The metal has been carving out a descending trend line since those January highs, with each successive rally getting stopped a little lower than the last. That looks bearish to the casual observer. To someone who understands what these patterns actually mean, it's a loading mechanism. The critical level to watch is right around the $4,500 zone. If gold can clear that level convincingly, with volume, with follow-through, you are looking at an express lane back toward $5,000, and potentially well beyond. The analysts at StoneX have flagged this exact resistance convergence. The institutional desks know where this level is. When gold breaks through it, the momentum traders, the algorithmic systems, the ETF flows, they all pile in simultaneously, and that initial breakout can become explosive very quickly. Now, here is where most retail investors make a costly mistake. They look at a chart like this, and they think, I'll wait until the breakout is confirmed, and then I'll buy. The problem is that by the time the breakout is confirmed on a closing basis, with the financial media declaring that gold is back in rally mode, the easy money has already been made. The people who benefit most from a breakout like this are the ones who understood the setup before it resolved, the ones who understood that the consolidation itself was the signal. Let me take a step back and give you the bigger picture, because the technical setup doesn't exist in a vacuum. What is actually creating the coiled spring in gold right now isn't just pattern recognition on a chart. It's the accumulation of fundamental pressure that has been building beneath the surface for years, now pressing up against a price structure that cannot hold much longer. Start with the central banks. There's a survey published by the World Gold Council, one of the most authoritative bodies tracking gold market data on the planet, and the numbers in their most recent report are nothing short of historic. Close to 9 out of 10 central bank reserve managers surveyed said they expect global gold holdings to increase over the next 12 months. A record 45% said they personally plan to add to their own reserves. Let that land for a second. We're not talking about small hedge funds or retail speculation. We are talking about the sovereign wealth managers of nation-states, the people entrusted with protecting entire economies, and they are loading up on gold at a pace that has no modern precedent. The numbers behind that survey aren't theoretical. In the first quarter alone of this year, central banks collectively purchased over 240 tons of gold. That's not an anomaly. It's the continuation of a trend that has now run for close to 11 of the last 12 quarters above the 200-ton level. China's central bank has been accumulating without interruption for 18 consecutive months. Poland, and people never think of Poland when they think about gold, has quietly become one of the most aggressive buyers on the planet, now holding over 550 tons, with gold representing roughly 28% of their total national reserves. Think about that for a moment. Poland's central bank has made a deliberate structural decision to park more than a quarter of the country's entire reserve base in physical gold. They're not doing that because they think the dollar is fine and treasuries are a great deal. They're doing that because they can see the same storm clouds gathering that anyone paying attention can see. Now, why are central banks doing this? You have to understand a little history to really feel the weight of what's happening. After the United States froze Russia's dollar-denominated assets in response to the Ukraine conflict, roughly $300 billion in sovereign reserves just locked and rendered unusable. Every central bank on Earth had a quiet internal conversation. It went something like this. If it can happen to Russia, it can happen to us. What assets can no one sanction? What can no one freeze? The answer, the only real answer, is physical gold held domestically. Gold doesn't have a counterparty. It doesn't require a SWIFT code. It doesn't need a custodian in New York or London. It just is. And the geopolitical lesson of watching $300 billion in reserves disappear overnight sent shockwaves through sovereign wealth management desks in every emerging market, and increasingly in developed economies too. This is the de-dollarization story, and people hear that phrase and they think it's fringe theory. It's not. It's a policy response to a policy decision. When the United States weaponized the dollar reserve system, it inadvertently handed gold its strongest structural argument in decades. Every nation that doesn't want to be vulnerable to financial sanctions now has a concrete, sovereign reason to hold more physical gold. The BRICS nations, Brazil, Russia, India, China, South Africa, and their expanding roster of partners, have been explicit about their intentions to reduce dollar dependency in cross-border settlement. Whether those plans succeed in full or only partially doesn't matter for gold. What matters is the directional shift in demand that they create, and that shift is already underway and measurable. Before I keep going, I want to quickly mention, if you're watching this and you're within a decade of retirement or already in retirement, check the description below. I put together a free guide that walks through the saving strategies that thousands of American retirees are using right now to protect the wealth they've spent decades building. It's there for you, free. Just have a look. Let me bring this back to something that hits closer to home for most of the people watching this. The United States national debt recently crossed $39 trillion. The math on what that means for your purchasing power is not complicated. The debt is growing at a rate of roughly $8 billion per day. Interest payments on that debt have crossed the $1 trillion annual threshold. $1 trillion a year just to service what we already owe. Not to pay it down, not to build anything, just to stay current on the interest. And that number will only grow as debt is rolled over at higher rates. Here's the critical link. When a government is running deficits of this magnitude, when the trajectory of the debt is structurally upward with no credible mechanism for reduction, the only real tool available to the monetary authorities is to make the currency worth less over time. Inflation, in other words, is not a bug in this system. It's the intended feature. It's how the debt gets silently written down in real terms. Your savings, your pension, your fixed income, your money market, all of it slowly loses purchasing power as the supply of dollars grows to meet the government's borrowing needs. Gold, historically, is the asset that most reliably moves in the opposite direction from purchasing power. When the dollar loses ground, gold gains it. This is not a recent discovery. This is the 5,000-year track record of the metal. Think about 1971. That's when President Nixon severed the last link between the dollar and gold, closing what was known as the gold window. Before that moment, foreign governments could exchange their dollars for gold at a fixed rate. After that moment, the dollar became entirely fiat, backed by nothing except the full faith and credit of the United States government. What happened to gold after 1971? It went from $35 an ounce to nearly $850 by January of 1980. That is a 2,000% increase in roughly 9 years. The people who understood what severing the gold standard meant, who grasped the long-term implications of removing the anchor from the currency, those people preserved their wealth. The people who trusted the official narrative that the dollar would remain strong did not. And here's the thing about 1980 that most people don't know. When gold peaked at those levels, the financial media declared the bull market over. Inflation was being crushed by the Volcker Fed. Interest rates were raised to extraordinary levels, and gold came down hard, staying suppressed for roughly 2 decades. Everyone who didn't understand cycles assumed gold was dead. What actually happened was a long, patient reset, a compression, before the next major bull market began in the early 2000s and took gold from under $300 to $1,900 by 2011. Every generation, it seems, has to rediscover gold's role, and every generation that ignores that lesson pays for it with their savings. Now let's talk about the paper gold market versus physical gold, because this is where I think the next breakout really gets fuel injected. The COMEX, the exchange where gold futures are traded in the United States, operates on a system where the overwhelming majority of contracts never result in physical delivery. Banks, institutions, and traders buy and sell paper claims on gold. At any given time, the volume of those paper claims is vastly larger than the amount of physical gold that could actually be delivered. This works fine as long as everyone is content to settle in cash and no one actually demands the metal. But something has been changing quietly over the past several years. Physical delivery demand has been rising. The London Bullion Market Association, which is the other major gold trading hub, has been experiencing its own strains. There have been documented cases of delivery delays, widening spreads between paper and physical prices, and a structural migration of physical gold from Western vaults to Asian vaults, particularly in China and India. When the disconnect between paper claims and real metal becomes too extreme, the resolution happens fast and it happens violently. Gold analysts who track COMEX warehouse inventories and registered stocks are watching some very interesting numbers right now. The ETF picture reinforces all of this. Global gold-backed exchange-traded funds currently hold over 4,000 tons of gold, representing assets under management in the hundreds of billions of dollars. In April, after a difficult March, ETF flows turned strongly positive again, over $6.5 billion of net inflows in a single month. Europe was the primary driver, with Asian demand continuing its unbroken streak. What ETF flows tell you is this: when the institutional and retail investors in the developed world, particularly in Europe and North America, decide to chase a gold breakout, they have the firepower to move markets in a meaningful way. The Wall Street money hasn't fully committed yet. That's not a bearish signal. That's what a breakout setup looks like before the institutional crowd arrives. Let me tell you about a pattern that keeps repeating itself in gold markets. It happened in 2008. Everyone remembers that gold fell during the initial financial crisis, the panic selling phase, the liquidity crisis, when every asset got liquidated to meet margin calls. Investors watched gold fall and concluded it had failed as a safe haven. And then, within months, gold went on one of its most powerful sustained rallies in history, ultimately more than doubling from those crisis lows over the following years. The people who panicked out during the 2008 correction missed the entire move. The people who recognized that a global financial crisis, a massive expansion of central bank balance sheets, and extraordinary monetary stimulus would ultimately be fuel for gold, those people made life-changing returns. We are in a structurally similar moment right now. The pullback from the recent highs has spooked a certain segment of holders. The narrative has shifted toward correction is over, time to sell. But look at what's actually happening beneath the surface. Central banks are buying. Sovereign nations are diversifying. ETF assets are near record highs. The debt trajectory of the major reserve currency issuer is unsustainable, and the chart is coiling at exactly the kind of technical inflection point that has historically preceded major upside moves. What exactly do you think is going to happen when all of that converges into a single upward price move? This is also the moment where I want to speak directly to the retirees and near retirees who are watching this, because the stakes for you are genuinely different than they are for a 25-year-old investor. You don't have 30 years to ride out another lost decade in equities. You don't have infinite time to wait for the bond market to recover from the rate shock it's still digesting. What you need is something that protects the wealth you've already built. Something that has demonstrated over centuries, not just decades, the ability to preserve purchasing power when paper currencies come under stress. One of the most underutilized tools in retirement planning right now is the Gold IRA. And I don't say that as a sales pitch. I say it because there are tens of thousands of American retirees who have no idea that the IRS actually permits you to hold physical gold inside an individual retirement account, with the same tax advantages you get from a traditional or Roth IRA. If you have $100,000 or more sitting in a 401k or an IRA right now, you can roll a portion of that into a gold IRA without triggering a taxable event. Physical gold, allocated, segregated, in your name, sitting in an IRS-approved depository, protected from the kind of counterparty risk that exists in stocks, bonds, and paper currency instruments. With everything happening in the world right now, the geopolitical fractures, the debt explosion, the currency debasement, the potential for a significant market dislocation, understanding how a gold IRA works and whether it's appropriate for your situation is simply responsible planning. The free guide in the description walks you through the basics. Take a look. Now let me bring this all together, because I want you to see this the way I see it. You have a chart that is compressed, coiling, testing a critical resistance level. You have central banks, not retail speculators, not YouTube influencers. You have sovereign wealth managers buying with both hands at a level that exceeds any historical average. You have a US debt structure that is mathematically committed to ongoing currency debasement. You have a geopolitical realignment that has created permanent, structural new demand for gold as a neutral reserve asset. You have a paper market that is increasingly strained by physical delivery pressure. And you have an ETF infrastructure holding hundreds of billions in gold-backed assets poised to see massive inflows the moment institutional sentiment turns bullish. What are you waiting for? What signal do you need that you don't already have? The question I hear most often from people who understand all of this is, am I too late? And I want to address that directly because it's actually the wrong question. The right question is, what happens to people who aren't positioned when this breaks? Because we've seen what happens. We saw it in 1971 when the gold standard was severed. We saw it in 2008 when the Fed expanded its balance sheet in ways that were previously unimaginable. We saw it in the post-pandemic inflation era when purchasing power fell at rates not seen since the 1970s. Every single time, the people who were positioned, who held real assets, who had exposure to gold, came out the other side with their wealth intact or enhanced. The people who trusted the system, who kept everything in dollar-denominated paper, learned an expensive lesson. History is not repeating here. It's rhyming, as it always does. The setup is different in its specifics and identical in its structure. A monetary system under stress, a reserve currency losing credibility at the margins, sovereign nations quietly accumulating the one asset that has served as money for 5,000 years, and a chart that is coiling at resistance, loading up energy, waiting for the trigger. The breakout isn't something that might happen someday. The conditions for it are already in place. The fundamentals are already aligned. The institutional positioning is already shifting. You are watching the spring compress. What you decide to do before it releases is entirely up to you, but at least now you understand what you're looking at. One last thing. If you've watched this all the way to the end, I want to reward that. I mentioned the free guide earlier for people who want to understand the saving strategies retirees are using to protect their wealth. But for those of you who made it here to the end, if you're an American retiree with at least $100,000 in any retirement account, mention that you watched to the end when you reach out through the link in the description. There's a no-obligation, one-on-one educational web conference available, complimentary, with a specialist who can walk you through exactly how this works for your specific situation. No sales pressure, no obligation, just education. Because at this stage of the game, you deserve to make this decision with all the information in front of you. That offer is for people who made it to the end of this video, only available to American retirees who meet that threshold. The gold market is sending a signal. Whether you hear it is your choice.